it is there.
Okay, well, the big headline this week was TCS's numbers, right? Kicking off their first quarter numbers, good set of numbers coming through. Management commentary was also positive. Rima, you have a bull and a bear case scenario for TCS.
Yes. So actually, the Nifty IT index was the best performing sectoral index this week as it closed out with a gain of nearly about 4%. TCS led the charge in the frontline pack. So we thought it's a good time to put forth the bullish and the bearish argument. So let's start with the bull argument. Are we at the beginning of an earnings upcycle or an upcycle for the IT stocks? Is the worst over? Some reasons. One, very strong numbers from TCS, a beat on revenues, a beat on margins, and even BFSI, which was under pressure for them, has clocked in a positive growth. It's a modest growth, but after 5 quarters of a contraction sequentially, this time BFSI has thrown in a little bit of a growth. The second reason is that the IT stocks have gone through some time correction. They've not given you any return over the last 3 years. And the third reason is that IT stocks are very sensitive to the global interest rate cycle. So when interest rates rise in the US, you saw IT stocks underperform. And now there is hope that perhaps in September or November, interest rates in the US will come down. And typically, IT stocks globally and in India react to that positively when the interest rate cutting cycle begins. So that's the bullish argument, which makes a case for stocks to do well from here on. But on the bear side, right, analysts are quick to point out that yes, Q1 was fine for TCS, good set of numbers, but the management is still very cautious. They're not confident to call out any recovery or turn in demand. We quizzed them many times on the discretionary demand, but they're saying it's not deteriorated, but it's not come back. There is no visibility. So the management is still cautious, and they're not talking about demand sustaining from these levels. Also, history tells us that even if stocks do well, right, over the last 1 month, 3 months, but if it's not backed by earnings, you quickly see the stocks being sold into. And these are stocks which have done very well in the last, 45 days. In the last 45 days, names like Wipro are up 25, 30%. HCL Tech too has seen a 17% return. And the final argument which the bears are making is the valuation. The Nifty IT is trading at a 30% premium to the Nifty, higher than the historical averages of 20%. And it's not that the Nifty IT EPS growth, at least for the large caps, is going to be so much more. The Nifty IT is likely to see an EPS growth of 10% over the next 2 years, which is in line with the Nifty EPS growth. So therefore, there is no justifiable reason why the Nifty IT should trade at a premium to the Nifty. So that's the bull versus the bear argument. But let me throw this question across to you, Gautam. Where do you stand on the IT argument?
So look, our strategist is